Last week we celebrated the temporary end of the government shutdown and freedom from another debt ceiling crisis for the next 15 weeks. But when the dust settled, many of us were a bit shaken, not because of the scare tactics used on both sides, but because we had vividly witnessed just how broken Washington really is, and how the need on both sides to pander to voters seems to trump any hope for solutions to the two serious related problems that now really threaten Americans' future: our out-of-control fiscal mess and our chronic inability to create quality jobs. Both sides got us into this mess, and it will take both sides working together to get us on a track that offers some hope for the future. That's really the scary part. What we so badly need now are ideas that will work for all sides, actually bring players together, and attack the root cause of these daunting challenges. This short presentation provides one such idea. Our unprecedented debt and deficit mess just gets worse. The hole we are digging for future generations, now measured at a staggering $17 trillion, forever grows deeper at an unprecedented pace. As the Congressional Budget Office warned Congress last month, no one should be fooled into thinking that the problem has been addressed because the annual deficit for the fiscal year that ended a few weeks ago, which was much higher than anything we had ever seen before 2009, was actually less than the unbelievable trillion-dollar-plus deficits of the last 4 years. The fine print in the Congressional Budget Office's recent 10-year budget projections and President Obama's recent 2014 budget proposal both confirmed that even under very favorable growth assumptions, the total federal debt will be fast-tracked to an unimaginable $26 to $27 trillion within 10 years, which translates to over $250,000 for each household in America and more than 16 times the total combined annual budgets of every state in the union. It also means that the ever-growing annual interest tab on the debt, if rates stay reasonable, will hit nearly $1 trillion within 10 years, consume over 3% of our entire gross domestic product, and claim 1 out of every 3 personal income tax dollars collected by the federal government. And if more shameful downgrades or a heightened lack of confidence in America and the dollar's role in the world force interest rates on the debt to high levels, everything will get much uglier much faster. The situation was aptly summed up by the President's National Commission on Fiscal Responsibility and Reform in its report entitled The Moment of Truth, where the Commission stated, "If the U.S. does not put its house in order, the reckoning will be sure and the devastation severe, because our federal debt is unsustainable." Of course, our debt mess is fueled by a chronically sick unemployment situation. The anemic recovery of the last 4 years has brought us to a point where more than 90 million Americans over the age of 16 are not now in the workforce, an all-time high. Our labor participation rate is a pitifully low 63.2%, the lowest in decades. Our unemployment rate, when adjusted to include part-time workers who want full-time jobs and short-term unemployed individuals, sits at 13.7%. And over 6 out of every 7 net new jobs created over the last 4.5 years has been a part-time job. But who really needs such statistics to know that something is seriously haywire with America's employment situation? We all regularly see it everywhere in the young of America who can't get started. Hordes of graduates with degrees and no paychecks. Seasoned workers trapped in dead-end part-time jobs. Declining real incomes throughout the land, and dashed hopes and dreams of countless couples and families of all ages who are struggling in ways that they could have never imagined just a handful of years ago. Our leaders do acknowledge and openly agree on one critically important fact: that the key to any real cure is America's private business sector, growing, successful, closely held businesses that historically have created 65% of America's new jobs and provided over 70% of Americans their first real job. We have proven beyond any doubt that when it comes to job creation, aggressive monetary policies and mammoth deficits are no substitute for the creation and growth of profitable, closely held businesses. We need these businesses to be stronger, and we need many more of these businesses. Now, we are not talking here about tax shelter enterprises for the rich. No, our focus here is creative, risk-taking builders of profitable businesses that stabilize communities, create permanent jobs, escalate income levels and consumer demand, and grow government coffers at all levels. But the hard reality is that this powerful job-creating force has become the pawn in the all-important tax-the-rich battle that has always divided and probably will forever divide the powers to be in Washington. The result has been a paralyzing instability and uncertainty for closely held enterprises. Many of us can reasonably support the extra tax hit that the recent fiscal cliff legislation imposed on the Wall Street crowd, Hollywood, pro athletes, the idle rich, Warren Buffett, and others with big incomes. But because we lump the business builders with this rich crowd, these tax bumps just drove up the costs and uncertainty for the business builders and triggered additional startup and growth disincentives. They significantly reduce the after-tax amounts that can be reinvested for growth and job creation, and added new uncertainties by requiring businesses to once again rethink core strategies, everything from choice of entity planning to buy-sell agreement structures to capitalization structures to incentives for key executives to transition and exit strategies and much more. It's little wonder that surveys of successful business owners in 2013 confirm that 79% of them think America is on the wrong track. 87% of them long for more certainty. Only 15% of them plan to add permanent full-time jobs in 2013, and 78% of them view the national debt and deficit crisis as a threat to their business. The solution for these businesses is a smart package of permanent tax provisions that decouples closely held businesses from the Buffett Wall Street crowd for tax purposes and provides these businesses with the tax certainty and powerful growth incentives that they so badly need. With such a decoupling, the Democrats could continue their push for tax rate hikes on the Buffett Wall Street crowd, while the Republicans continue their push for lower across-the-board rates and a broader tax base. The prospect of comprehensive tax reform could still be debated and go forward. Meanwhile, and this is the key, America's closely held businesses would be off and running with a smart permanent fix and would no longer be held hostage as the pawn in the tax-the-rich stalemate. What might such a package for closely held businesses look like? Here's my proposal, just 6 points. Point 1. Any closely held business with assets of less than $50 million could elect to be called and taxed as a small corporation. A small corporation would pay a flat income tax of 20% on the first $10 million of its earnings. Regular corporate rates would apply to any additional earnings. This would allow 80% of all earnings to be reinvested for growth, a 25% increase over the current level. Point 2. Any new investor in a small corporation who holds his or her investment for at least 5 years would be allowed to exit and sell out tax-free. It would be a permanent extension of a temporary tax perk known as the 1202 perk. So any investor who puts up his or her money and stays in for 5 years would pay no taxes when the investment is sold. Point 3. Dividends paid by a small corporation would be tax deductible by the corporation and would be taxed to the shareholders at a flat 20% rate. This deduction would mean no more double taxes for small corporations. Owners who elect to take earnings out as dividends would pay taxes at a flat 20% rate. Point 4. Taxable earnings retained and reinvested by a small corporation would increase the shareholders' tax basis in their investment. So there would be no risk that reinvested earnings that have already been taxed once at the corporate level would be taxed again when they are realized through the sale of an investment in the enterprise. Point 5. The first $500,000 of losses realized by an investor in a small corporation would be entitled to favorable ordinary tax loss treatment, so the losses could offset other taxable income. This would be a tenfold increase over the existing dinosaur $50,000 limitation that we've had for decades. And finally, point 6. Existing S corporations, partnerships, and limited liability companies would be allowed to easily opt in and be treated as a small corporation and play by all the new rules. A smart, permanent package along these lines would immediately provide powerful benefits to help get our closely held business community fired up and back in the business of creating jobs. A much higher percentage of a company's earnings, 80%, could be reinvested for growth. These higher investment amounts, when compounded over years by debt leveraging impacts, can dramatically boost a business's capacity to finance growth, as much as 200% to 400% over a 10-year period. There would be strong incentives for investors to fuel existing closely held companies and start new enterprises. Unlike public companies and larger corporations, double tax burdens and fears would be gone. There would be a single 20% rate at the entity and shareholder levels. Investors who stay in for 5 years could exit completely tax-free, and if an investment turns bad, ordinary tax loss treatment up to $500,000 would be available. Beyond these growth incentives, the package would create a much simpler tax world for closely held businesses and the IRS. The small corporation would become the hot ticket. Existing choice of entity complexities would completely disappear for nearly everyone. The rule-laden S corporation would quickly become extinct. Most profitable limited liability companies would shed the complicated partnership tax rules and opt for small corporation status. It would be a no-brainer. The K-1 form hassles, accounting challenges, and other burdens of pass-through entities would vanish for nearly all. Imagine a world where nearly all of those messy K-1 forms are eliminated. That would be serious tax simplification of the absolute best kind, both for taxpayers and the IRS. But perhaps best of all, the package would structurally decouple tax rates for the rich and small business growth incentives. No longer would America's closely held business community be a pawn in the battle over how to tax the rich. This would create great flexibility for the future. Rate changes for the rich up or down would no longer impact business incentives. So too, changes in business rates would no longer automatically flow to the rich. What it would all mean is many more jobs, higher real income levels, a growing, vibrant business community, rapidly escalating government revenues, and a much better promise for the future. Is such a permanent business tax package politically possible at this time? Why not? It could come from either side of the political aisle without dismantling that side's broader core tax theme for the future. A smart deal like this would really leverage and push the let's do now what we can agree upon theme by focusing hard on America's closely held businesses and what is needed to get those businesses fired up right now. It would create a targeted, badly needed sense of urgency. The goal would be bold, permanent, pro-growth incentives, not another short-term quick fix. The existing tax the rich stalemate promises to keep America's closely held businesses indefinitely stalled in a haze of impossible tax uncertainty. At this critical juncture, America and its closely held businesses deserve something much better, much smarter from Washington. This would do it. Thanks for your time.